Over the past 2 years, we've seen an extraordinary environment for fixed income investors, but the world is starting to shift again. Welcome to The Pitch. I'm Sarah Allen, and today I'm joined by Anthony Kirkham from Western Asset Management. We're going to discuss the outlook for fixed income and how Anthony's investing. Anthony, thank you for joining us. So to begin with, the portfolio invests mainly in government, corporate and superannuation bonds. Are these allocations targeted, or are they based on how you see the world at any given point in time?
Yeah, the positioning in terms of the different sectors is definitely very fluid. It's an active bond fund and we're trying to maximise the return for our investors. So we definitely rotate through the sectors, based on obviously the economic environment that we're in at the time, and also just based on, where we see the best value within those sectors. So, that's obviously a big part of what we do. The key to the fund though, remembering it is meant to be a defensive part of your portfolio. So we want to make sure that it actually behaves like a bond fund should. So the key for us is to obviously have a minimum investment within government and semis. And that gives certainly our investors some comfort that that's, that's going to be the ballast that you're looking for within the fund. And then after that, it's really just finding the right balance between the different sectors within it, where we see the best value. And that's really the key for our focus, alongside obviously trying to generate income. So it wants to be defensive, but we want to generate income for our investors, and it does pay monthly. So that's an important part of investing in the bond fund.
What's the highest allocation you've got at this point?
Obviously, benchmarks is what we're managing against, and it's fascinating to see how benchmarks have changed over the years. Obviously, with government debt going up considerably, it's really crowded out a lot of the other sectors within it. And we saw that certainly post-pandemic with all that sort of issuance by government. And we just don't believe we need to hold that level of allocations to government. So, we've got to find the right balance. And therefore, we do have allocation to government, but it's going to be out in the back end of the curve because that'll provide the best sort of hard duration, that defensive aspect that we're looking for the fund. And then it's really looking at where we can find the best return for investors. So we'll have an allocation to SSAs. They're good, solid AAA issuers that we really want to have as part of the fund. Semi-governments have been issuing a lot more lately too. As you probably well know, wherever you drive, whichever state, there's a lot of work going on. But therefore, they're issuing a lot more bonds. So we've been underweight semi-governments because we expected those spreads would widen. And then really our most, our largest conviction would be in credit, where we just think the fundamentals are really very sound. The actual spread that you're getting, or the yield that you're getting on corporates, is actually, I would say, quite generous based on those fundamentals. And therefore, we do have an overweight to credit, but it's very much short focus. So we're capturing the year without sort of taking a lot of risk within the companies that we're investing in. So, that's sort of the balance that we have in the fund. You could say it's sort of a bit of a barbell. So you've got that defense, but you've also got, some good allocation to income generating assets.
So let's talk about how you're seeing the world today. Inflation, interest rates, corporate health. It's a big question, but what's your take on the macro backdrop?
Yeah, look, it's been a tough one, obviously, on the inflation side. Obviously, that generated by that super easy monetary policy, the super easy fiscal that we had through the pandemic. And then, out the other side, inflation was there as a big risk factor, and central banks clearly had to tighten monetary policy, bring that down, and the only way to do that is obviously bring activity down. So, we're seeing that occur across the globe, and inflation now is coming down. In Australia, a little bit more challenged, a bit more nuanced if you want, partly because, we do have this services inflation that is running a little higher than most. Obviously, everyone's had a similar environment, but in Australia, it's just hanging on a little bit longer. Clearly there's a bit going on at the government level. There's a lot of spending going on there. We've, mentioned it already that, there's clearly a lot of expenditure going into infrastructure and the like. And so that is obviously generating a bit more activity. And therefore, it's a bit more of a challenge for the RBA at this time. So in terms of that easing that's going on elsewhere, we've got to wait a little bit longer. But we think, basically early part of 2025, we'll see the RBA in a position to actually start easing. But we do still think it'll be a relatively shallow easing program because, I think the economy is sort of feeling some pain at the moment. But as we move through 2025, we believe that the economy will start to feel a little bit better.
How has the portfolio changed over the past 24 months? And as it stands today, where are you seeing the best opportunities?
In terms of the best opportunities, as I mentioned, we still see those best opportunities within the corporate sector. As I said, I think the good thing about what the corporates did through the pandemic was they actually, got their leverage down. They got themselves in a safe position from that perspective, and they've pretty much maintained that since the pandemic. And so therefore, as interest rates rose, they were in a position where they weren't really harmed by, sort of high leverage and those higher rates. And so therefore, fundamentally, just because of the type of corporates that do issue into our market, which are definitely more of a high grade nature, they're obviously got a position where generally they're, monopolistic, duopolistic type companies. We do have a lot of infrastructure and utilities that actually issue into our market. So they're sort of very much defensive in nature. And so therefore, once again, feel comfortable having an overweight to them, just keeping it short. So that brings in that income. And then it's really just, as I said, looking at markets, seeing where they're moving. And for us, duration management's become very important, partly because of that volatility we've seen in markets, that uncertainty about whether the economy is going to have a soft landing, hard landing. Those factors certainly drive the volatility within interest rates, and we are trying to actively take advantage of that. And when markets seem to be getting a little carried away in terms of their expectations, then we can move duration up and down on that basis and take advantage of that volatility, which has really added quite a bit of value for the portfolio as well this year.
Thank you so much for sharing your insights today.
My pleasure.
If you've enjoyed this interview, please subscribe to Livewire Markets. We're adding more great content every day. Thank you for watching.